Hello everyone, welcome back to the Mr. Chang channel. Losses are inevitable in trading and investing, for both experienced traders and beginners. What really matters is how you handle those losses, because that determines your long-term results and your future mindset. In today's video, we'll go back to the root cause of losses to better understand the psychological process behind them, why we lose, what actions lead to losses, the different types of losses, and how to deal with them effectively. Let's get started. First, let's talk about the core nature of losses. At the root of it all is a simple idea: buying high and selling low. After entering a trade, price can only go up or down. So why do most people still end up losing? Because they keep buying at high prices and selling at lower ones. We can divide losses into two main types: long-term investing losses and short-term trading losses. In long-term investing, whether in stocks or crypto, there are two main factors that directly affect losses: the product and the price. For the first factor, it's simple. If you buy a bad asset, it will always remain a bad asset. If it can't grow, you lose money. For the second factor, even if you buy a good asset, if you buy it at a high price and sell it at a lower price, you still lose. So why do we sometimes buy low-quality assets or buy at high prices even when we know better? The main reason is greed and expectation. Normally, we can recognize bad assets or poor timing, but we still buy because we expect that if the price rises, it could multiply our capital much more than a safe asset. Or when we buy high, we believe it will go even higher, and if we don't buy now, we'll miss out. So what drives this strong expectation? The most common root cause is the herd mentality. When entering a new field, people tend to look for easy answers, trust others' opinions, and follow what everyone else is doing instead of making independent, objective decisions. In financial markets, money flows from one person's pocket to another's, so there are always traps designed to make you buy bad assets or buy at high prices. The crowd is like a school of fish being guided into a net. You either follow the directions set by those in control, or you follow the other fish around you. It's the mindset of, if everyone else is doing it, I should too. This is what amplifies your expectations. On a larger scale, this net isn't just small groups, it's everywhere. TV, news, social media. When the market is booming, you see people getting rich early on. Then later participants rush in and buy at high prices, thinking everyone is making money, why not me? Now imagine this. If you were investing alone, no groups, no outside influence, no knowledge of who's getting rich or losing money, your expectations and greed would be much lower. You'd focus more on your own research, whether the asset is good, whether the price is reasonable, what risks are involved. Even without a solid strategy, your decisions wouldn't be driven by greed or herd behavior, and you'd likely avoid major losses. To actually make profits, though, your decisions must be based on a clear strategy and proper risk management. If you can buy good assets at low prices, losses become very unlikely. Only the size of profit varies. Unless, of course, you panic and sell lower due to emotions. So in long-term investing, losses come from buying high and selling low. And that behavior comes from buying poor assets or buying good assets at the wrong time, driven by greed, expectations, and external influence. Once you understand this root cause, the solution is to block those influences, educate yourself, and build a solid investment plan. After controlling greed and expectations, the next step is discipline, strictly following your plan. Now let's move to short-term trading. There are two main types of losses here. First, losses from not using stop-loss orders. If the market moves against you and you don't cut your losses, your account can be wiped out. Even if you sometimes recover, you'll never achieve consistent profits because one strong move against you can erase everything. So if you trade short-term, you must use stop-losses. If you refuse to use them, then you should switch to long-term investing. The second type, even if you use stop-losses, you still lose a lot. The biggest reason is over-leveraging, trading with position sizes that are too large. When you lose a large amount, your first thought is to recover it. This leads to revenge trading, more entries, more stress, and more mistakes, resulting in even bigger losses. So what should you do after a loss? Accept it.
take responsibility. Blaming the market or your strategy prevents you from recognizing your own mistakes. As humans, emotions like greed, fear, and hope are natural, but in trading, they are your biggest enemies. When you truly accept your losses and acknowledge your mistakes, you can start controlling your emotions and improving. Many people already know common advice. Don't overtrade, take breaks, reduce position size, don't stare at charts too much, but knowing is not the same as doing. These are not the root causes. The real root cause is emotion and lack of discipline. This applies not just to trading, but to life. People know smoking or drinking is harmful, yet they still do it because they enjoy it, until serious consequences force them to change. Similarly, in trading, it's often only after losing a lot of money that people become more disciplined. The key solution is to create a strong mental link between your actions and their consequences. Remind yourself daily, lack of discipline equals losing money. Build this into a reflex. Over time, your brain will associate bad actions with negative outcomes, making you more cautious and disciplined. However, no one is perfectly disciplined from the start. It's easy to plan, but hard to follow through. Going off track due to emotions is normal. What matters is regularly reviewing your actions, identifying mistakes, and correcting them. Improvement doesn't come from chasing results, but from fixing small mistakes every day. If you correct one mistake daily, you will steadily improve over time. The worst thing is continuing down the wrong path without realizing it, wasting time, effort, and reinforcing bad habits. To summarize, eliminate emotional influence, follow a structured plan, and build strong discipline. Write down your rules, keep them visible, and clearly define the consequences of every action. The stronger the mental connection, the more seriously you'll take your decisions. Also, regularly review your trades. Break down your mistakes into small parts and fix them one by one, from the simplest to the most complex. Many beginners focus on big things like finding the perfect strategy or making large profits while ignoring small, fundamental mistakes. But if you can't follow simple rules, you won't be able to follow complex strategies either. That's the key message of this video. Focus on root causes and core actions, not surface-level advice. Hope this video helps you. Have a great week, and see you in the next one.